Hi folks, Merry Christmas and let's hope for a Happy New Year. Some time ago I made a chart comparing interest rates to the S&P 500. Recently I updated it to include the most recent period of zero interest rates that we've seen. Here's something that I hope you will find interesting. I charted the Fed funds rate from January 1993 to December 2009. Obviously it runs from the left scale to the right. Here's where we are now. December 2009 and a Fed funds rate of virtually zero. Here is the peak at 6.5% interest, which ran from May to December of the year 2000, and the ensuing low of 1% from June 2003 to May 2004. It is around this period that liquidity was finding its way into the housing market, sowing the seeds of our current woes. The Fed funds rate versus SPY, the ETF tracking the S&P 500. I'm sure that you will have noticed the challenge to conventional thinking, the myth of interest rates. Conventional wisdom which suggests that rising interest rates crush stock prices and that falling rates stimulate the market. I first published a version of this chart on a message board in 2007, when the Fed cut rates after a market sell-off. I'm not unique in charting this relationship, nor in using it to challenge conventional thinking, but I do think that I have something to contribute to the discussion. At that time, back in 2007, the market was struggling, and the consensus was that cutting rates would save the day and support stocks. This chart, at that time, suggested otherwise, and was subsequently proved correct. Rates were slashed, but the market continued to fall, just as it had done from the peak in 2000. I'm afraid it's now time to look at this chart from the other perspective. Stocks have made a major move up, rates have bottomed, but rumblings are being made that they will rise over coming months. In other words, we have the opposite scenario. Clearly, interest rates and stocks have, during the period in question, generally enjoyed a somewhat surprising relationship. There was a period from 1995 to 1998 where rates were falling a little while the market actually rose, but taking simple tops and bottoms in 2000, 2003 and again in 2007, it certainly looks as though stocks and rates have a correlation, and that stocks lead the relationship, not the other way round, as is generally touted. Why would this be? Surely rising rates should kill the market, and easing of rates stimulate it. Isn't that what we've just seen in the recent rally as liquidity from 0% interest rates gushed into the market? Take a look here. The stock market bottomed in early 2003 with rates at 1.25%. The rate had another cut down to 1% and was held there for 1 year. In June of 2004 the rate ticked up, back up to 1.25% and continued to rise in small increments until the peak in 2007 at 5.25%. It's worth noting that stocks turned up before interest rates, and I suggest that one could guess that money was coming out of bonds and finding its way back into more risky assets such as stocks and houses at that time. Such an exodus from treasuries forces yields higher, dragging the interest rate with it. The Fed, contrary to popular opinion, does not, cannot simply choose a rate it likes, announce it on TV, and that's the end of that. It doesn't work that way. It can suggest a target rate, but then it must manipulate the treasury market to compete with other forms of investment which, at the time, have a perception of low risk. In brief then, this chart is telling us that stocks move first and interest rates chase them. This might make sense if you think about it. Stocks rise from a beaten down position, then money comes back out of treasuries to chase the higher returns being seen in stocks, and interest rates are therefore forced higher by the falling price of treasuries. Conversely, at a top, stocks tumble in anticipation of recession, as interest rate rises finally begin to take away the punch bowl from drunken speculators and consumers stuffed to bursting with debt. Cash again flows back to treasuries, moving their price up, the yield down, and interest rates can then fall. The economy and the market finally started to roll over in late 2007. Jim Cramer pounded the table and demanded that Bernanke open the discount window and lower rates in order to save the market. Well, that fat, bald oaf should have saved his breath, as the die for interest rates was already cast, as cash fled to perceived safety in treasuries. And so we come to the current situation. Interest rates have bottomed. Zero is, I think we can agree, the bottom. The question is, how long can the Fed maintain rates at this low level? We know that the Treasury market is under pressure, and that the Fed is the buyer keeping prices up and yields down. Stocks have made an initial move, something like we saw in 2003. In fact, they've made a hell of a move, as we all know, from March 2009. And interest rates look set to rise as foreign buyers grow wary of the dollar and the Fed begins to talk about raising rates. This, by the way, is not the Fed suggesting their own choice to come. They are merely signalling that their control is slipping and that rates might be forced up by the market. They can't tell us that, of course, so they have to talk about maybe raising rates at some point in the future, rather than admit they have very little choice in the matter. So, what to do, and where will the market go? I wish I knew. But I first published this chart, as I said, on a message board in 2007, and at that time the consensus was that cutting rates would save the day. It didn't. I'm afraid, however, it's now time to look at this chart from the other perspective, and that gives us a problem, because I'm very bearish on the situation, but, you know, I went with this chart at the top, when rates were at the top, and now that rates are at the bottom and stocks have moved up ahead, I have to at least look at the situation as it is now. I think personally, as I said, that the market will fall again. That's just my own opinion. It would also appear to make sense that rising interest rates would kill any recovery for housing and speculation. But, as I said, this chart was right at the top of interest rates, so we have to at least give it a look for the bottom. And interest rates at zero have certainly bottomed. Perhaps this chart tells us that the real crunch will come when rates actually do make a tick up. At that point we'll see what the market does, and if the market were to hold up from whatever level it is at that point, be it lower or higher than actually today, but if it were to hold up from that point, then there seems to be an argument made in this chart that it could continue to go higher, even in the face of rising rates at that time. One reason might be that rising rates might flush out the tire kickers, the folks sitting on the sidelines with cash waiting to mop up bargains in the next phase of deleveraging on assets, houses and so on and so on. Those of us waiting for lower asset prices and continued low interest rates. When rates rise or begin to rise, it might spur a sudden bout of buying as people try to beat the new trend of rising rates, and this might feed back into support for the market. That would certainly explain some of the apparent oddity of rising rates and a rising market that we've actually seen in the past. Of course, if, or perhaps when, more likely when, the derivatives blow-up comes along and drives cash back into treasuries, this discussion might become moot for a while, as rates could remain low by all that money rushing into the perceived safety of treasuries, and therefore that would maintain the low interest rates, whilst at the same time the market could tumble horribly again on the back of the deleveraging, the fear and the deflationary effect of that decimation of debt and capital as debt defaulted. But I think what this chart is really telling us is, let's see if rates do take a tick up in the middle of 2010, wherever the market is at that point, let's see how it reacts. And if it goes up a little, I don't think it's going to be the time to short straight away, thinking that, well, if interest rates are rising, that's going to kill any kind of hope for the market. We need to see. No predictions here, but certainly food for thought. Thank you.